So, from a seller's perspective, once they've sold their policy to us at Coventry and to our institutional partners, they've got no more obligations. That's it. They're done for that. They've received their money for their policy. And so there is no risk to them anymore because they've already sold their policy. They're done. Insured
Hello,
to be
hello.
final.
Ginny Bolling here with Pivotal REI, the Pivotal Real Estate Investing Podcast. And I have here today Matthew Paine. Matthew, thank you for coming.
Thank
He
you. Appreciate the invite.
he is extremely versed in real estate and in insurance products and many other things, alternative, shall we say. And so I want to let you go ahead and introduce yourself the way you would prefer to be introduced and tell people a bit about yourself.
Well, wonderful. Thank you again for the invitation. Always love to jump on these podcasts and share some knowledge and share some stories and hopefully provide some education for your listeners. So I very much appreciate the invitation and look forward. Again, my name is Matthew Paine. I co-founded a company called LifeCap. LifeCap is a firm that works specifically with high net worth individuals, a category called family offices, which are the very high net worth individuals, and institutions, pensions, endowments, things of that nature. And I teach them about alternative assets. And specifically, I focus in lately on a very specific niche asset class called the longevity oriented assets, sometimes commonly referred to as life settlements. And I also work with a company called Coventry, which is the founder of the life settlement industry. They created it. So I work with them too on bringing the opportunities of life settlements out to the marketplace to individual seniors that maybe want or need their policies, and to financial advisors, insurance agents, and others to educate them on there, and also to how to invest in alternative assets such as life settlements for those that are interested in the investment side of the business. So, yeah, I've been in alternative assets for the last 18, 20 years, raising capital, structuring products from everything you've already mentioned, real estate to oil and gas to energies to longevity, which is insurance based products. I've been dabbled in a number of different asset classes, raising capital for to achieve these types of goals with developing alternative asset platforms. So again, happy to be on and look forward to this conversation.
Right. Well, with all of that, we know there's so much going on in commercial real estate and all alternatives really. Right now, crypto even and some other things. It's kind of exciting to see gold as well and silver. But you landed on a very unique one, and I really, really, really have had my eyes opened only in the last year about insurance products because so often we just don't want to face, what insurance entails or means or all,
Sure.
all of that. And so if you've got that negative thought in the beginning, it's doing a disservice to you. And it's really important, I think, that people listen up on this because it really opens doors to not only making your life or maybe your loved ones' lives better, but you can also build wealth and income through these life settlements you're talking about. It's just amazing to me. So go ahead and talk. Well, first, what's your takeaway going to be?
Uh, my takeaway, first of all, is for anybody, whether you have a family member that is a senior, and I say seniors, I mean 65 years of age or older type individuals, or if you yourself is a senior and you have this life insurance policy that you've had for years or your family's had for years, and they're now in a position or you're in a position where it's simply no longer wanted or needed or you can afford it, please do not let that policy go back to the insurance company, but get out, know that there's a market for that, and that market may be interested in buying that policy for a considerable amount more than what the insurance company is willing to give to you, and that's meaningful to you or to your family member in those retirement years to pay for long-term care, to help with the funding needed in their retirements, to make life easier or to experience new. So my takeaway is never let anybody that has a policy that's a little bit older let that policy go without first checking to see if there's value in it in the secondary market.
That's terrific. And that's key. We're going to say that again towards the end too.
Yeah.
And so, yeah, that begs the question right away that well, how often do people let them lapse? I mean, is that the biggest reason that insurance companies don't pay out?
Yeah, so that's so a little bit of just to step back. I'm a recovering insurance agent. I'll say it that way. I'm a former life insurance agent and financial advisor. I was grateful to be able to build that practice and sell it many, many years ago. So I was shocked when I heard these numbers. As somebody who is a big believer in life insurance, especially for things that you've just kind of alluded to a little bit, which is how do I invest? How do I use this on some tax advantage ways to grow my wealth? I found out that the majority of life insurance policies, in fact, over 80% of all life insurance policies will actually not result in the payment of a death benefit. That is, let's sink that in for a moment. Over 80%. I'm going to put that into a dollar number. This is the insurance industry's own numbers. These are not mine. I don't make these things up. It's all researched online. The insurance industry last year alone, over 700 billion, that's with a B, dollars in death benefits and life insurance policies were lapsed or surrendered alone. Just last year alone, $700 billion in policies were lapsed or surrendered. People gave up those policies instead of continuing to pay those premiums and to receive the death benefit later on down the road. So that alone last year, and then an estimated over 80% period will not result in the payment of a death benefit, was something that was shocking to me, and really was the reasons why I started to get involved in this space, was to say, wait a minute, how do I help the 80% of people who were paying all this money in and didn't get anything for it at the end? And how do we create a better way for them to capitalize on this activity, such as buying a life insurance policy? So yes, the majority of policies do not result in the payment of a death benefit. They go lapsed or surrendered, and the insurance company keeps that.
And so how do you help people?
So there is this market called the secondary market for life insurance. So kind of like if you think about it from a real estate, well, the primary market is building a home, right? I build a home and it's sold to the first buyer. That's the primary market. But when that buyer, that original buyer of that home decides, or the apartment complex, like the one that's in your background. And so when they decide, the original owner decides, I want to sell it, I'm out of this thing, they go to the secondary market. There could be secondary market of real estate, which is huge. It's robust. It's a secondary market for lots of different investments. Everybody knows it because the stock market, the New York Stock Exchange, NASDAQ, the bond market, those are all secondary markets. That's where everything is being sold. So that's what we do from the life insurance standpoint, is we bring that policy to the secondary market. We determine if that policy has value and what value that may be. And then we go back to the original owner, typically the insured, that individual that's 65 years of age or older that's looking to get rid of it. And we say, hey, I know that the insurance company is willing to give you X, which means your cash value, whatever you've built up into it, or maybe zero if there's no cash value. But the secondary market may be willing to pay more for that policy. And so then we make that offer for that client to sell that policy for that amount, typically much greater than what the insurance company wants or is willing to give, excuse me. And then the institution that buys it then will become the new owner and hold on to that policy, be responsible for that policy, and receives the death benefit of that policy,
And
at
it's
the
a
end.
sure bet. They're gonna die.
Yeah, so that's always the interesting. That's my always the running joke. I say, what's mortality rates running at in the United States today? And if you listen to the way I phrase that question, it's really important. What are mortality rates running at in America today? And the answer is 100%, just to your point. It's a sure bet, right? It's not a matter of if, it's a matter of when.
Yeah.
And so, unlike any other asset, we know that the end is going to happen. It's not a matter of if, it's not a matter of when. So it is considered very much largely a non-correlated asset because it's not affected by economic conditions. What is the political environments? What is the happening in currencies or whatever the factors that are going on in our world? We need one event to happen. That event is certain. It's not. It's going to happen. We just don't know when. Now we can do underwriting on that, and that's done. We do underwriting when we buy it, and so that we're buying it at a specific price. Um, but how we mitigate that, the not knowing when, is you buy lots of policies and then you participate in the law of large numbers. Some will pass away earlier and you make a lot of money. Some you'll pass away a lot longer, later, and you don't make as much. And over a large pool of policies, you kind of average that out. That's from the investment side. And that's why the investors build these portfolios to do this. But for that individual that's looking to sell their policy, that's an immediate cash in their hand that they can do with it as they choose.
So yeah, there's a lot to uncover there. But
Sure.
so if grandma and grandpa are gonna let their insurance lapse though, and you're um maybe a niece, a nephew, or whatever, they could potentially find it worthwhile to take over those payments for them to keep it going so that it's as an investment, it's still all that money's not wasted, right?
100%. The first thing that I tell people is always talk to the family, talk to the people, especially the beneficiaries. It's no doubt that the most important thing about a life insurance policy is that it is in force on the one day you need it to be enforced, which is the day of mortality, the day of death, right?
Yeah.
Um, and insurance policies, specifically the ones you're alluding to, which are considered permanent policies, that's what they're called, permanent policies that allow for cash value to be billed, are tremendous vehicles. They're allowed there's different types of policies in which the underlying investment grows at various ways, depending on those policies and how it's structured. And there's creative ways and great ways to pull that money out to use while you're still alive for various needs. And there's ways to do that in a very tax advantaged way to minimize our tax obligations that we're paying. And there's even ways in which we can utilize these insurance policies to pass on legacy to the next generations and even multiple generations. So, first and foremost, I'm an insurance person, lover by trait and and I believe in it. And I believe that there's strong power in utilizing those policies correctly to help you on your estate needs and income needs. But if it comes time where there's a situation where the policy just simply is no longer needed or wanted, a term policy that maybe we know is going to end anyways because it's a term. There may be some opportunities even for a senior to sell that term and make money, which you were going to get zero for because
Really?
there's no cash value in term policies. But there is a market for, again, somebody that's maybe 60, 65 years of age, even close to 70 that has a term policy that we may want to buy that policy. That's very common that we may look into that because what we would do is convert that policy to a permanent and then keep it going. So, yes, I think policies should be talked to with the family, see how we can keep that policies and fund it properly. And then if that can't be done, then know there's a secondary market to help them sell it if they want to.
That's so valuable. So, so valuable. I don't know if you've seen it. There's actually a commercial that I saw not that long ago where there was some older people sitting in rocking chairs and some guys down under the floorboards that are listening to them talk about, I don't want to pay premiums anymore for my insurance policy. And they're going, you think they know there's a market for that?
Right,
Have you
right.
seen that commercial?
So I have, and
Yeah.
again, so I help. I work directly with Coventry on. Coventry again is the founder of this industry. They're the ones that discovered this industry 25 years ago. They are the largest in the industry. And as a matter of fact, over 50% of all these policies that are purchased initially are done so by Coventry or Coventry controlled entities.
50%.
They are the market. They're most of the commercials that you'll see out there are done by them, and there's others that are out there that do it, and they're bringing a valuable message that
Yeah.
says that again, do you know that there is this market if you can? Because we believe in the power of funding those insurance vehicles properly, but there's always 80%, more than 80% of the time they're going to get rid of it, and we need that avenue to help them with that.
Right. Yeah. And now, is it important if it's a term policy, does the original person have to be the one to convert it, or can you guys buy it and then convert it?
Yeah, that's a great question. In many cases, um, that conversion could be a very costly endeavor. When you convert that term over to permanent, that's going to require a significant amount of capital. So we, as the buyers, will actually convert that. So that's a cost that does not come out of the seller's pocket. So the seller, that individual, could sell their term policy, and then now the new owner will then fund it to convert it and pay for it to convert over if they've done the analysis and the analysis makes sense that it's worth to buy it. There's got to be an underwriting that's done first,
Right.
but that's factored in. So no, that's a great thing for the seller to understand is it doesn't require them, one penny out of their pocket to if they're going to sell this policy, only a little bit of time to review paperwork and doesn't even require medical they're go see a physical or anything like that. It's all done using medical records and with systems and companies that do this for a living. This is what they do.
Right. Well, so one of the webinars I've had in the past, as I mentioned before we started recording, was about the infinite banking and the whole life policies where you can borrow against it and have that same dollar growing here and working over here and maybe over here, right?
Sure.
Can you talk on that a little bit so that tie it together for people?
Sure. So if you look at there's the insurance industry has done a great job of creating wild and crazy names for different insurance policies, but there's really only four basic types of life insurance policies that are out there. We already talked about term, so everybody knows what term policies are. I have a 10-year policy, a 20-year, a 30-year, whatever it is. If you don't die within that time frame, at the end it goes away and it's done. It's like renting an apartment in the real estate world, right? You don't build equity in a rental apartment. When your lease is up, you're done. You hand them the keys, you walk away. Same thing with a term policy. If you didn't die, you hand them back the policy and you go, thank you very much. So, term is renting an apartment. Then there are permanent policies. And permanent policies, really, there's three types. There's a whole life policy, which you alluded to. There's a universal life policy, and then there's a variable universal life policy. All of those policies that I just named, whole life, universal, and variable, all have the ability not only to have a death benefit, but also the ability to grow cash inside that policy. So all of those do. Now, at what level and how aggressive and what they get invested in varies differently between those policies. Which one is correct is really dependent on the individual and their insurance agent and their financial professional to determine, what is the goal out of my investment needs and what I'm trying to accomplish here on whether it's whole life, universal life, or variable universal life. Whole life is going to be more of your conservative cash growth. The insurance company determines that investment, it's going to be lots of guarantees, but of course, with guarantees come lower rates of return. It's very, quite logical that if they're going to promise something, they're not going to promise you the moon. They're giving you a very small promise of a guarantee, but we know as long as you pay it, it'll be there and it'll grow at this level, maybe slightly better if you're lucky. Universal life is the next step up, where it's invested a little bit differently, where it's got some opportunity to grow a little bit more, maybe not huge amounts, but it can grow a little bit more. Still has some guarantees within it, um, but that's allows for a little bit better cash value growth, but without getting exposure necessarily to market fluctuations. And then variable universal life. The V in variable is the important part. It allows you to choose many different types of investment vehicles. They're called sub accounts. Um, in which you can choose to invest in many different things that look, that are like mutual funds and exchange funds. You got a little guess there. And so there's a lot of things that you can invest in for potential growth, but there's also volatility. So you could make money, you could lose money. There's ways in which, but you can be more aggressive in variable. So term, renting an apartment, whole life, universal life, variable life is buying a home. It just depends on how aggressive you want to invest in those different investment vehicles. Most any of those investment vehicles, that money is being grown on a tax deferred basis. So the growth is not being taxed. And if properly structured, if you take it out correctly, in many cases, you can take that out without a tax obligation. If done properly, again, you would really want to work with your insurance agent and financial professional to make sure that you're doing that properly, so that you don't, misstep and all of a sudden create a taxable event for yourself.
Right, right. And there's another perk, I think, too. Aren't they also protected from bankruptcy and other claims? Am I right?
Yeah, and so I mean, I'm not a lawyer, so I don't want to make sure
Yeah,
I don't want
yeah,
anybody to hold me to it as a non-lawyer. But my understanding is that there are certain protections that an insurance policy has relative to other assets when it comes to maybe more significant issues such as bankruptcies and things of that nature. We do know that a death benefit of a life insurance policy, if paid to a beneficiary that is a family member or has some kind of a relationship, that's done at a non-taxable basis. So so that's a benefit to the beneficiary if it's not done from a business standpoint or an investment standpoint. So there are tax treatment benefit treatments, again, if done properly. But I want to make sure that people consult with their lawyers and their financial advisors and insurance to make sure that they're structured properly. There's limitations on how much you can put into it, or else they become what they call a modified endowment contract, which is a terminology that's used in the industry to say, oh, you overfunded it. Now that's going to become taxable, things of that nature that you want to try to avoid.
right. Yeah. Well, and so talk a little more, if you would, about the things that people maybe give us some examples of how people have been able to benefit by doing these life settlements.
Yeah, that's a great question. And that's something that's just amazing. I have met thousands of individuals that have sold their policies. They received money in their hand for that policy, and it made real differences in their lives. I've seen people that were living on fixed incomes that extra money really made a difference in just making their ends meet. A lot of them maybe in their retirement years are on fixed income. And that extra money really makes a big difference. I've seen people use that for long-term care needs. We know that as we see more and more, as we see increase in longevity, people living longer, we see more and more need for things such as in-home care, um, or nursing home care, or just retirement communities, assisted living type facilities. Well, the money that now can be used for those types of facilities and those types of services, which makes a meaningful difference. I've seen people use them for to allow for medical procedures that they needed to get done, and now they found this money that allowed them to do some very significant medical procedures that made a huge impact on their lives. I've seen them used for things such as help with mobility. Maybe it allowed them to then go be able to purchase some kind of a mobility equipment to help them get around more and things of that nature.
Or that-
So
like that.
we could spend an hour on all of the on all the reasons why people utilize this money, and some of them they've got plenty of money, so they use it for fun. And that's great too.
Yeah, go
And you love
travel,
to,
take that trip, right?
yeah, go travel and buy your grandkids some extra gifts, and buy that boat or whatever, whatever it is. Um, and then there are very wealthy individuals, and very wealthy individuals also have lots of life insurance policies, and they maybe just no longer needed their policy anymore because they used it as loan collateralization and stuff like that. That's we're talking for the very wealthy people. I see that quite often. And there they just, now they're selling that policy, and they're taking that and investing it in other things that they're doing. So there's a myriad of reasons or opportunities to spend that money in a way that's very meaningful to that person who sold the policy, that they never knew that that even existed before that. They didn't even know that that money existed until they went through this process.
Yeah.
And it's great. It's when you get to meet those people and shake their hands and see how much it saved their lives and it made meaning into their lives. It's a wonderful experience.
And that's huge. You see a lot of it too, because the ultra wealthy know how much insurance can be a tool. And
Yeah.
it's huge.
Yeah.
The number of benefits. I like I said, my eyes are open. I'm going to go ahead and get licensed to sell insurance for just that reason. I always had this negative thing about, I don't want to talk about death or think about that stuff, and couldn't be more detrimental to your way of thinking than
Yes.
just that, right? So,
There's two certainties in life, death and taxes.
yes.
So made famous by Benjamin Franklin, that phrase. And look, I mean, it's nobody loves to talk about our own mortality, right? And that's a vulnerability that we all have as humans that
Yeah.
we don't want to talk about. But what a wonderful gift it is to embrace that conversation, so that we know that our families are taken care of, that we know whether when we're alive or in our passing, that we know that we have financial windfalls that are able to help our family members in times when they very much need it. And then, of course, the wealthy, which they really know how to use this to their
We really know how
advantage,
to
like
use
you
it. Yeah.
mentioned. Yep,
Yeah.
absolutely.
Um, so to make it a little more realizable maybe, or realistic for some people maybe, do you know some statistics on what the average policy is and what the typical life settlement amount might be? Can you talk in some generalities?
Yeah, sure, absolutely. And again, that's an important word, generality, right? Generality, just or let's talk averages, right? But what is an average? It means 50% or less than 50% or more, and everybody, so it's always going to vary. But let's take kind of an average. So the average age of an individual that's doing a life settlement is going to be in their 70s. But that means that 50% are younger and 50% are older. So that's the average, right? So that's why I say 65 years of age or older, because, average is going to be in their 70s. So in their 70s, uh, the average port the average portfolio or policy size, excuse me, is roughly around $500,000, but we'll see policies as low as $100,000. They won't buy policies lower than 100,000, but that's as low. And we've seen policies that are in the millions, to even 5 and 10 and even greater million than that. So, but 500,000, but know that it's really about $100,000 on up is the size of the policy, that we're looking at. So what are they paying out? So again, this is averages. Now everything is dependent on health of the individual. The sicker the individual, more than likely, the more valuable the policy would be. The healthier the individual, the less the policy value probably will be. That's just kind of just by going assumptions. Um, economics of the policy itself. There's certain different policies and their underlying costs all have to be weighed into it. But on average, payment is about 20% of the face value. So let's just take a hypothetical $1 million policy, right? So we have an individual that walks to their mailbox. They open up that letter from John Hancock or Transamerica or whomever, Prudential, whoever it was, and they got this premium notice and it says, hey, you owe us a premium payment on this $1 million life insurance policy that you've had for years and years and years, but maybe you haven't been funding it the way we probably should have been funding it, like we've talked about. And now all of a sudden they can't afford it anymore. They no longer need it or want it. And so maybe they're not going to get very much for it. Maybe it's dwindling. The cash value is dwindling. There's not much left. Um, but may they go to the market, on average, that's probably going to be worth about $200,000 for an investor. So the investor might pay them $200,000 for a policy that the insurance company may only pay them 10 grand or 20 grand for it, depending
Wow,
on what that
divergent.
cash value is. So there could be a significant benefit. But I want to caution everybody that's average. So whenever that means that no one's probably going to buy it for 20%. Maybe they buy it for a little bit more. Maybe they buy it for a little bit less. And that's hard for people to kind of understand that it's going to vary in range depending on a number of factors that we have to look at the, because everyone is individually underwritten. We don't do a blanket purchase of anything. We look at that individual, their health, their medical needs, their medications, all that kind of stuff. Then we look at the underwriting of the policy, its health, its monetary needs, its, that, and we weigh all that together. We use software that's the industry creates software. And then ultimately comes out with the price that we're able to pay. So it's a very sophisticated, um, highly regulated. It's all regulated by the state insurance commissioners on what we do and to protect those seniors that are selling their policies. But highly regulated, very sophisticated, to protect the environment of everybody selling and buying. But average about 20%. So 70 average is 70, but probably down even to the 65 years of age range. $100,000 plus policy, probably low cash value. That's kind of what everybody's looking for, or maybe term still. And about 20% of face is what is being paid for on average for those policies.
So how would the transaction go? Do you do it in their kitchen, or since it's regulated, is there some other ways to handle that?
Yeah. So it doesn't need to be done in people's kitchens. If they wanted to, they can. But typically, how it is done is that the individual, more times than not, is working with an insurance agent or an advisor that probably brought this opportunity to them and saying, "Hey, did you know? While
Oh,
we're
they do tell
reviewing
them?
your stuff, yeah."
That's good.
And so then they submit the policy then to Coventry, as an example, the firm that I work with. So then Coventry will work with that individual, that seller, and their insurance agent or financial advisor. That individual signs off. They sign off on a HIPAA release form so we can go get medical records on the individual and protect everybody from, because you have to operate under HIPAA guidelines, and so you want to make sure everything's protected and secured and all that. Uh, and they grab all that information so that they can do an underwriting on the individual. The individual doesn't have to do anything other than kind of sign off on the appropriate documents, and then the firm goes to work to pull their medical records and their medications and all that. And at the same time, they look for information about the policy. They get the economics of the policy, like I said, and they put that all together and they come out with the value of it. Then they turn around and come back to the insurance agent and advisor and the client that's selling and say, hey, here's the value we've placed on this policy. Here's the offer we're going to make with you for this. And then the client can choose. Do they want to take that offer? Do they choose not to? That's strictly up to them. No costs to them, really no time other than out of their, that they have to give other than signing off on a few documents. Really very minimal from the client, the seller's perspective or the client. The client can choose to sell it or not. If they choose to sell it, then it goes into a closing process not dissimilar than to a mortgage. document. Similar. It's those documents are regulated by the states. Everything is all word for word is derived from what the states require to protect everybody. So those are very boilerplate type documents that are kind of to make sure that we change ownership from the current owner to the new owner. And then they receive monetary compensation for that, whatever the agreed upon offer price is. So then once that transfer has happened, the money gets exchanged, and then that's done. So that process can take a little bit of time because you're dealing with the insurance company and you're dealing with doctors' offices and things of that nature. So it can take a few weeks to kind of get everybody to play nice with each other and get all the documents delivered in a timely manner. But really, it's not the person isn't really doing much other than just signing off on the appropriate documents when needed. Most of the work is done behind the scenes.
That is terrific to know that there is some regulatory purview on that, because it could be kind of a corrupt industry probably otherwise.
Yeah, I think it's important to know that same with the securities world, the insurance industry is very highly regulated. Each state has their own state insurance commissioner. And all of those insurance commissioners together form the National Association of Insurance Commissioners, the NAIC. The NAIC is the governing body that oversees all the insurance commissioners of every state. And so there are regulations on the books at the NAIC level and at the state level in regards to these transactions for the purpose of protecting those sellers, those seniors that are selling their policies, so that it's done so in a very regulated, transparent manner so that they understand what is happening.
That's
We
terrific.
don't want people to think that they're being taken advantage of. We
Right.
want to make sure that the family and the beneficiaries know what's going on so that they understand this transaction, and it's for the best for that seller.
Yeah, that's huge. Now, do you have people sometimes that want to get an income stream? They don't trust themselves with getting a lump sum or whatever?
Well, I think that that's where the role of their financial advisor and insurance agent really comes to play, which is, when that monetary amount is paid, then that's when the financial advisor and insurance agent can step in and work with that client to say, hey, we may need to supplement our income. And so then they can bring to them different opportunities on ways to drive income to them. So that's really, we believe, should be best handled by the insurance professional or the financial professional of that client to dictate with them what is the best avenue for them to put this money to work to satisfy their need.
Good, 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 good. Also, is there a risk for the insured that the insurance company could fail? Is that something that they should be worried about? What's the likelihood of that?
Sure. So I think that there's in everything that we do, right? There's always risk. There's always risk in real estate. There's always risk in everything that we do, and we have to understand that. And it isn't about avoidance of risk. It's really about risk mitigation. Is an important phrase that I think everybody should be understand when they're getting involved in investing. So, from a seller's perspective, once they've sold their policy to us at Coventry and to our institutional partners, they've got no more obligations. That's it. They're done. They've received their capital for that. They've received their money for their policy. And so there is no risk to them anymore because they've already sold their policy. They're done.
Right.
To the buyer, the new buyer, yes, there is risk, right? Is the insurance company a quality company? Will that insurance company be around, in the next X amount of years to pay this death benefit off? What are the risks of that? And that's something that when those companies that are building these portfolios of these policies, they look to develop risk mitigations. And there's ways in which they can reduce the risks of those types of things by building portfolios certain ways to address that. But from a seller of a policy, once that they've sold that policy, it doesn't matter to them
Yeah.
what happens after that because they're no longer receiving any kind of compensation.
And it sounds like for, say, me as a buyer, your advice would be don't buy just one, buy a portfolio of them so that you're
Right. And that's why I work with family offices and institutions. An individual, typically, unless they've got, you know, 50 million or 100, like very large sums of money, they're not going to build their own portfolio. And that's kind of the numbers that you really need to really build big portfolios. So from a investor perspective, not unlike being a limited partner in a real estate fund, there are settlement funds out there that you can be a limited partner in as well. And so there are different options like that in which an individual person can be a partner in these portfolios. Again, just like a real estate portfolio. But if you're going to buy just one or two, boy, there's a lot of risks involved in something like that. And for somebody that's been in this business for 20 years, I tend to highly discourage buying one or two policies, as I don't think that that's going to necessarily wind up the way you want it to be. So definitely I help people understand what investments that are out there. And then for those that are bigger, how to develop their own.
terrific. All right. Um, what else should I ask you?
I think that, again, kind of going back into the investment side, I think again, it's the wonderful thing about this investment on life settlements is its non-correlation factor. And because you already mentioned it, the end result is a certainty. It's not an if, it's a matter of when. Um, I'm always very cautious about this phrase called non-correlation. I think that term gets kind of abused a little bit because people will say, well, this is a non-correlated asset. Uh, Me being in the alternative asset space, my first question is, well, non-correlated to what?
Yeah.
Let's be very clear, because when people say it's non-correlated, well, there's many assets that may be non-correlated to stocks, but may be correlated to economics or to currencies or to other things. And so understanding what really means non-correlation, I would definitely want people to better understand. And on this investment side, it is also considered an illiquid asset. So it meaning you're not going to just get in and out of it right away. You got to hold it for periods of time, and that's extremely important. Generally, when people invest in illiquid assets, and I see this in real estate too, is people are generally okay with it illiquid until they need liquidity. Then all of a sudden they're not okay with illiquid, right? And so it's like I don't need to be concerned with it until I need to be concerned with it. And at that time, it's a little bit late. And so I would highly caution anybody that is investing in an illiquid asset that they really spend time with their advisor to determine what other assets do they have that are liquid, so that if things happen in the environment, if markets turn or they have a medical need or they have another opportunity, that they have the ability to access capital somewhere to be able to take care of that, instead of trying to force the hand of an illiquid asset that may then need to be sold at a wrong time in a wrong environment that's just didn't produce the way it should have because it needed more time to build and do what it needed to do. So I'm very, very cautious with people. I love illiquid alternative assets, but you got to make sure that you're prepared with having liquidity somewhere else to protect yourself on that. And then, of course, with life settlements, uh, I, I, I can't stress enough that more and more people need to share the story with their family members and their friends and their neighbors, and it is. I joke. There's a reason why the insurance companies have all the tallest buildings in all the downtowns in America, is because they're not paying on 80% of the policies that they say they're going to pay on, yet they're collecting premiums every month, every quarter. I don't know about you, but I pay my premium payment every month, every quarter, right? And they're collecting all of that. So it's this is a great opportunity for them. But boy, not enough people know about it, and what they do know may not necessarily be correct.
So I hear some people say that the reason insurance companies don't pay out so much is because they always find that loophole so that they don't have to. But how often is that really the case?
Yeah, I mean, I get why they. I mean, I get it, but in reality, just like life settlements, the insurance industry itself is governed by the state insurance commissioners, and the state insurance commissioners are not owned by the insurance agency. They're there to protect the insureds and the owners of those policies. That's who they're there to protect. Yes. Are there language in policies that say we won't pay a death benefit if, and then there's a whole section of what are those things?
Maybe
Um,
suicide or whatever, right?
yeah, suicide typically within the first couple of years. After a couple of years, that clause goes away. Um, if you committed fraud in setting up the policy, if you lied, I'm not a smoker, and yet you were a two-pack a day, like that kind of thing. Like you committed fraud in falsifying information when you set that policy up in the first place. You're going to be subject to an analysis by the insurance company, and they may not pay. Um, More extreme measures, if you're committing a felony and you pass away in the act of committing a felony, the insurance company isn't going to pay your death benefit if you're committing this felony, this crime. They're not going to reward that. So that's kind of a little bit more extreme, and you don't see that very often. But there are, um, in the policy, it'll state the reasons why they won't, and people, need to understand that. But for the most part, the insurance companies are going to pay. They're by law have to. It is a contract, and they are bound by that contract. So I think more of the questions become is how secure is your insurance company? Are they a quality insurance company? Do they have good, strong financials? Have they been around for a long time? And those are the questions that people I think should be more asking relative to loopholes that I just don't see are happening too often in the business.
Do many insurance companies close or fail?
Very, very little. What happens in the industry is that if an insurance company does start to get into a position of financial trouble, what happens the lion's share of the time is that they sell the assets off to the other insurance companies, and so they get gobbled up by the other insurance companies. And so, is there a risk of that? Of course, there is. We can't say that it's guaranteed that they're not going to fail, but generally, in the overwhelming, if a company in a rare occasion has economic troubles, generally their assets are sold off to the other insurance companies, and then they continue on with those contracts. I can't tell you how many insurance companies John Hancock's purchased over the years, and Transamerica has purchased. They just the smaller firms that they've purchased up, bought their contracts up, and it continues on. So that's what you see happening the overwhelming majority of the time. But there's always that risk, as small as that might be.
It's a marketable asset. So
Yes, exactly. And it has real value. And now that you learned, 80% of the time they're not paying it anyway. So why not buy that asset and collect the premiums? Because there's not a lot that they have to pay out.
So here's another question. If somebody wants to cancel their whole life policy that does have a good cash value, say it's a nice one, a few $1,000,000, but for whatever reason, they just don't want to pay those premiums anymore.
Right.
If you were to, as a family member, to buy it, would you be able to also borrow against it like the original owner was able to do, or does that go away?
No. So the benefits of the policy follow the owner. And so if you were to change ownership of a policy, so in your scenario that you just brought up, parent says, I no longer want this policy anymore, and I change the owner to a child or a grandchild. So you physically change ownership, then the rights of that ownership change to that new person. That new owner now has every right as the original owner did to that policy, borrowing, leveraging, all of the factors that are associated with that policy change if there's a new owner. So that's important to understand. Mind you, the insured never changes. It's always the original insured always stays the insured. But the new owner of that policy has the rights of the previous owner and the original owner. So now that just becomes, how does the parents, do they want to just change the ownership? Do they want to take their cash out first, then change like that's all between the family members and what they want to do. But no, new owner has the same benefits as the original owner.
Now, why would they take the cash out first and then transfer it? Because they want to
Because
do
they
that trip?
maybe they wanted the money and then they said, you're going to get the death benefit, I want the cash now to do with it as I choose,
That's
and
right.
then you pay the premiums and then you get the death benefit when I'm gone. So
Right.
therefore
Because
the
there's still
family
the
now
death
is using
benefit.
it. Yeah,
Right.
there's still the death benefit. So that actually happens quite often. I see that happening very often. They'll take the cash value out and then they'll sell it, whether it's to a family member or to a life settlement, or whatever, but they've taken the cash value out of it. So
So do you have stats on how many of those people use it for vacation or for,
no, yeah, I don't have those lockdown numbers, but they definitely, there's a lot of ways in which they can have fun with that money.
well, this is
But yeah,
fascinating. It really is. And it's called life settlements.
yes, life settlements, the secondary market for life insurance, just like the secondary market for investments.
Amazing. Yeah. We will promote this heavily so that people will learn about it. My brother always was
Sure.
big on buying a lot of life insurance. So I have to especially be sure
Yep.
because
Yeah, and if they want to look to potentially sell their policy, I would highly encourage them to visit Coventry.com. That's Coventry.com. And Coventry, the largest and the biggest firm, and easily can then help that individual in selling their policy.
very good. Very good. So one more time, why don't you give us the takeaway?
Got it. So again, regardless of whether it's you or your family member, if anybody in your family or you that are in your seniors, you're in your retirement years, age 65 or older, if you have a life insurance policy, even if you want to keep it, it is a wonderful process to go and get an analysis of that policy to determine what is the true value of that policy today. You could maybe choose to keep it and keep going. You may be able to choose to sell it and utilize that cash for whatever else that you may need. But do not let that policy lapse or be surrendered back to the insurance company without first understanding what that value of that policy truly is in the marketplace. So anybody age 65 years of age or older should be doing that, even if they plan to keep the policy, just so they understand the true value of that policy.
Right. And talk to the family members about it.
Yeah, open up that conversation, as uncomfortable as that might feel. Open up that conversation and engage them with the need for that policy.
That's terrific. Yeah. My folks, when we were pretty young, started sharing their wills with us and make sure we knew where they were and all that. So we all knew what was in the wills and all that. So it's just one more conversation for us on that. But the life insurance part of it wasn't discussed really, but everything else was. So
Yeah, it's amazing, but making sure that everybody knows what policies you have, what's the policy number, what's the phone number or the email address of the insurance in company that issued it. If you have a financial advisor, an insurance agent that helped you with that, what are their contact information? Identify the people that can speak on your behalf in regards to the policies, making economic decisions and things of that nature. All of that should be discussed with family members and set up the appropriate access with the family members that you trust, so that in case of a situation, people know it's an emotional time, right? Mortality, death of a family member is an emotional time, and the easier it is that you can help with all the information in front of them, makes it, at least that part of it, a little bit more bearable, knowing that you're still dealing with the loss of a loved one.
and just to hit it home a little further, somebody suddenly has a stroke. They've been living alone for a long time, hasn't been sharing information with the family. Hopefully, they have executed one of these documents that gives assigns someone else to, if you're late making your insurance payment, that they're notified you didn't pay,
Right.
right?
Right.
Because
It's
otherwise it
critical.
lapses, right? And
Critical. We did that when my mother passed away. We needed to make sure that we had a, and my father had early onset dementia. We needed to make sure that we had some of the children, my siblings and I, assigned to things so that we were aware of everything that was going on, making sure that the bills were being paid with him and for him and all that because, you know, my mother was passed away and my father had dementia, so we needed to step in and be able to
yeah,
handle those situations,
yeah.
so very, very important.
Lots of valuable information here today. Well, thank you
Absolutely.
so much. So tell people how, oh, wait, first I have to say, is there a pivotal person or event that brought you to where you are today or is pushing you towards some particular goal?
So I met a gentleman back in 2007 by the name of John Sabis, um, who really opened my eyes to this industry and made me start to really think about it in a different way, this life settlement industry. And he was the one that really kind of opened my eyes and taught me this industry and gave me exposure to this industry. And we worked together for many, many years in bringing this story out to the marketplace. I spoke to thousands. I couldn't even count the number of people I've spoken to all over the country in regards to this. And I'm still passionate about it, 18, 20 years later, as I was that first day. So, a gentleman that I will always be forever grateful for introducing this industry to me that really has changed my life and taught me many angles and many different layers of this business and how to do it and how to do it correctly. So, that was a person who's really made a huge impact in this space for me. So,
That's terrific. And like I explained, we had the local legends and pivotal people series. So you can call them and let him know that you nominated him, or we can, but we want to honor him as a pivotal person, as having shared his knowledge, and he'll be promoted if he comes on the podcast as that and go on our newsletter forever and get a little lapel pin
sure,
that says he's a
sure,
pivotal person. So I
sure.
appreciate you sharing that with us. It's important for other people to find out who are those pivotal people in the industries. And so thank
Right.
so tell people how they can reach you, please.
You can reach me. Email is probably the best way to reach me. My first initial and last name. So it's MPAINE at LifeCap, LifeCap.com. mpaine at lifecap.com is the best one to reach me at. And I'm on my email all the time. So I may be traveling all around the country, but I've always got that phone and that email with me. So please reach out for any questions. Happy to have conversations with people about a variety of subject matters. As I'm traveling throughout the country, happy to help them with their questions.
Terrific. Well, thank you so much. Really appreciate it.